Hi, Jason Greenlees, your financial advisor, coming at you with another video. First of all, I apologize for the quality. All the equipment that I have for shooting these videos is at the office, and obviously being in isolation at home, I don't have access to it. So, like most of you, I'm guessing I'm sitting at home in isolation with my wife and two kids. We're all safe, and I'm hoping that wherever you are as well. I thought I would just take this opportunity to address where we are now with the investment world. I wanted to share with you how we're handling things right now, and I wanted to share with you some interactions that we've had with some clients that I think is important, some lessons to bring to all of you, and just kind of how to frame what's happening right now as best we can. So to start off, I've included in this cover email a chart showing all the bear markets that have happened since World War II. And as I said in my last video, bear market is just a fancy term for the market dropping more than 20%. And we entered that back in late February. So there's been 15 or 16 of these occurrences, and you can see them on the chart that I attached. The only one that's missing is this one, as well as the fourth quarter of 2019, where we had a short-term bear market. And I know this is brought on by coronavirus, and I know coronavirus is something that we haven't seen in our lifetime. Forget that for a second. I will come back to that, but I think it's helpful to look at what a typical bear market has done so that we know what we potentially are in store for. And so if you go and do the data and crunch the numbers on the bear markets that I've sent to you, you can see that on average they drop about 32%. And as of Monday last week, the S&P 500 had dropped 37%. Now we've had a big rally off the bottom in the last 8 days, up I think 22 or 23%, which again is very common in a bear market, but it's also very common that we get another leg down, which I'll talk about in a second. But at the end of the day, a typical bear market drops 32%, and that's pretty much where we are so far. So far this has been very average in terms of the magnitude or the depth of this bear market. What hasn't been normal, and I said this in the last video, is just the speed at which it's went down. If you go back to 2009, it dropped 57%, but that happened over a 2-year period, not 2 months. At any rate, an average bear market drops 32%. And more importantly, if you look at how long it took for each one of those bear markets to go back, for the market to recover the declines that it suffered, it's on average 14 months, just over a year, before the stock prices get back to where they were, and then go on to set new highs. Now, there's been several or a few that have been significantly worse than that, and you can see them at the bottom of the page that I gave you. You can see in 01 to 02 or 2000 to 2002, the tech crash, the market was down 53% and it took, or 50%, and it took almost 3 years to go back to where it was. And in the financial crisis, where it's dropped, the S&P dropped 57% and then took almost 3 years to go back to normal. So those are two of the worst that we've seen. And so this bear market that we have right now, it might not be finished. In fact, I suspect it's probably not. Again, I said a few minutes ago that it's very typical to get these bull market rallies where the market goes up more than 20% within a long stretch bear market. And so it would not surprise me if we had another dip in the market and we retested the lows that we had last week. It also wouldn't surprise me, being very candid with you, if we saw a 50% decline in the market from the top, which would be another 25-30% decline from here. But it also wouldn't surprise me if we had a big snapback in the market and we got some kind of whiff of good news. So we don't know what's going to happen in the short run. And for that reason, we stick to one of our core principles, which is market timing does not work. I've yet to see anyone do it with any degree of accuracy. Nobody. So therefore, we're not trying to time this market. It might go lower, it might go back up. We are not trying to time when that happens, because in our experience, that leads to more carnage than just living through it. And so we're sticking to our plan. I'll come back to how we're, the rebalancing strategy that we do in a second, but we're not trying to time this market. And we've had a few clients now that have gone against our recommendation, that maybe they're not market timing. Some it was market timing, some it was just being uncomfortable with the investment. So again, if you're one of those clients, and to put things in perspective, we manage net worth for and investments for about 250 families. And of the 250 families, we've had 6 that have reduced exposure to equities. Now, some it was because they became too uncomfortable, some was to do some market timing. And again, this is not a criticism of you if you're watching this video. I understand you did what you think is in your best interest, and I don't have a problem with that. But the rest of our clients, so 98% of them, are sticking to our suggestion, which is to not do anything, to just continue to rebalance the portfolio as opposed to selling. So looking at this as a typical bear market, so far it's been fairly average. It's been quicker than most, but it's been fairly average. But again, if you can look out 3 to 5 years from now, based on history, stock prices are going to be several times, multiples higher than where they are right now. And for all of you that have money in stocks, you have more than a 3 to 5 year time horizon, or I wouldn't have put you in stocks in the first place. And we have money in GICs and bonds, specifically to weather these types of storms, to generate the income that you need if you're spending money from your investments. And also equally important, so that I can now sell some of those to add to stocks and to take advantage of the fact that prices have gone down. And we'll be doing that again in June for our clients. So we're not trying to time this market. Looking at a typical bear market where we may be in for more pain, even if we are, I believe that we get out of this. And I know coronavirus is different. And people have said to me on a lot of the conversations that we've had, well, Jason, this is something that we haven't seen. And that's true. But the financial crisis, for example, was something that we had never seen. We were on the precipice of the entire financial system cratering, imploding, and we somehow got out of it. So I think, I saw this somewhere, I read this somewhere, from a hedge fund manager who said, look, you're either in the financial crisis, you're either gonna bet that the entire financial system implodes, in which case we're all in huge trouble, or we're gonna figure a way out of it. And I think that we're in the same place here, that you either bank on or bet that the entire system is going to implode with this virus, or that we get out of it. And call me an optimist, but I believe that we're gonna get out of it. And I don't know how, and obviously I don't know when. And I suspect it's probably going to get worse before it gets better. And it would not surprise me, as I said, I want to be really clear that the market could go lower again. I suspect it probably will. And again, that leads to temptation. Why don't I just sell now, wait for it to go lower, and then I'll buy back? And the reason is, A, the market could turn around and go back up. It doesn't have to go down. And B, even if it does go lower, there's no bell that goes off. And I said this in my last video that says, okay, now's the time to go in. And so in March 2009, there was still a ton of negative news coming in, and yet the stock market started that long bull market. And a lot of people were frozen out. They never got back invested. So in my experience, you're growing your net worth. You'll be far more successful by just riding this out, rebalancing the portfolio to get you back to your target weight, which means buying stocks, averaging in at these lower prices, rather than trying to time it. And I understand for some of you, it's not timing the market. It's just that you're just uncomfortable with watching the speed at which you've watched the value of your investments decline here. So you have to do what's right for you. We'll honor that. But I believe that if you stick to the plan, that what's worked for us for the past 26 years is going to work again here. And I also included in the cover email an attachment of a video that I came across recently from Peter Lynch in the 90s, who was one of the greatest investors of his generation, who ran Magellan at Fidelity. And he's talking about volatility back in the 90s. And I think the same applies today, and that is that volatility creates opportunity if you can take a 3 to 5 year time horizon. Now, some people have said to me, more than one, Jason, this might lead to a depression like we had in the 20s. In 1929, where the stock market dropped, 75, 80%. And it took more than 10 years for the market to go back to where it was. And that might happen here. Obviously, I don't have a crystal ball. But I believe that we're going to get out of this, and things are going to look more like a typical bear market, some of which I've just shared with you. So we're viewing this that it's brought on by coronavirus. Coronavirus gets solved somehow, some way, and that this becomes a typical bear market, which, and I say typical, they all vary in terms of shapes and sizes and magnitude and depth and length. But in the worst case scenarios that we've seen since World War II, you know, you're looking at a 3-year recovery before stock prices go on to set new highs. And so we believe you stick to the plan despite how things have gone. I said to you in the last video that we may be in lockdown shortly, and sure enough, here we are. And you know, I know there's essential workers that are still going out. That might even get tighter. And I suspect we're going to see more bad news coming out of New York. Hopefully it doesn't get as bad as what we saw in Italy, which was heart-wrenching. But it might, and it might even come like that here. So I don't know how thick these storm clouds are going to be or when they're going to dissipate, but we're managing your investments with the intention or the plan that we do get to the other side of this, and that we look back and say, wow, what an opportunity it was to add to stocks, which is, I think, Peter Lynch's point in that video, that short snippet that I sent you. So in short, we are doing the same thing that we've always done. I know that it's scary out there. I know if you're like me, you're worried about your health, your family's health, and that adds to the panic here. But we are doing the things behind the scenes here that we've always done that have kept our clients in good stead for the better part of 30 years. So Peter and Saul are working from home, and I'm working from home. We're accessible. I've reached out to most of you. I still got a few of you on my list. Sorry, it's taken a long time. These are long conversations. If for whatever reason I haven't got to you yet and you want to speak to me, please call me and I'll get back to you as quickly as I can. But other than that, I really want to impress upon you, we're following the discipline and sticking to the plan, knowing that, or believing that, we're going to come out the other side. So, in short, as I said to you in the last video, I hope wherever you are, you're safe. That's my greater concern here. And if you need to speak to us, we're here. Please contact us. If you call my office, I'll get the message and I'll call you back. And in closing, I'd say thank you for your continued trust and the confidence that you're placing us while we work our way through this. Stay safe.